Welcome to Within the Frame, where we bring the most pressing issues across the globe into focus. I'm Kim Mok-yeon. With 2025 coming to a close, the world's two biggest central banks are moving in opposite directions. The U.S. Federal Reserve signaling a shift towards rate cuts, and the Bank of Japan preparing for its first hike in nearly 2 decades. Now, that divergence is sending mixed signals across global markets, fueling volatility in equities, bonds, currencies, and even crypto. For South Korea, stuck between the two giants, the stakes are unusually high. So can the economy ride the tailwinds of a Fed pivot, or will the BOJ's tightening override that momentum? For potential answers to this, we connect to Shin Se Don, professor of business economics at Sookmyung Women's University. A big welcome.
Always my pleasure.
And also joining us is Han-Hyung Lee, an assistant professor of economics at Montclair State University. Good to see you.
Thank you for having me again.
So let's start with Professor Lee, the global backdrop first. So we're seeing a clear divergence. The Fed is pivoting toward rate cuts while the BOJ is preparing to hike. So how much does this signal a new phase for global monetary policy, and what are the risks of this split?
Yeah, it's quite interesting what's happening. As you alluded in your intro, so the Federal Reserve Bank yesterday has announced that it's going to actually decrease the interest rate for the third time this year. On the other hand, the Japanese central bank, the BOJ, and the governor Ueda has discussed it that the Central Bank of Japan is going to increase the rate for the first time in a few decades. So this really has big implications for the global currency and bond market. Why is that? Well, so if you look at some of the debt issue for both countries, the interest rates are being, the leading federal funds rate for the bond market. So that means that as the Fed lowers the interest rates, the new U.S. bond will have a lower yield, whereas the government bond for Japan will have a higher yield. So that means that global investors may likely to go to the Japanese bond for that reason relative to the U.S. bond. And as you know, U.S. and Japan, those are the two largest countries in terms of the global bond markets. And actually, Japan has the largest holding of the U.S. debt for most of the countries around the world. So that means that there's going to be some implications for the financial constraints, and that's going to have a ripple effect on the stock market, as well as the direct impact on the global center market for the bond. And so this policy divergence between the two countries have been really interesting for many investors to look at, because of the fact that usually, if you're looking at back at the global financial crisis back in 2007 all the way up to 2009, central bankers would like to go together in terms of policy coordinations because they typically prefer a minimum interest rate differential to minimize the impact on the global equity market. But in this case, we're seeing different issues because of the fact that they have domestic agendas happening in the United States and Japan. And for that reason, we're seeing that this policy divergence is going to have a lot of impact for the global market moving forward.
Right, indeed, a very unusual and impactful divergence we're seeing. Now, speaking of which, Professor Shin, there's also growing concern that the BOJ's tightening could trigger a yen carry trade unwind. How real is the threat of capital withdrawal from emerging markets like South Korea?
Well, I think that depends upon two aspects. First is how big is the yen carry trade. According to one source, the amount of total yen carry trade is about to be $20 trillion. $20 trillion is how big? Korean capitalization of the Kospi is about 2 trillion. So the size of yen carry trade is about 10 times the size of entire capitalization of Korean Kospi. So that's a huge amount of money. So if they decide to move from one place to another, that's going to have a significant financial implication. That's one thing. Second thing is, everything depends upon how high the Bank of Japan will raise, its policy rate next week. It is expected that current rate is about 0.5, and it is expected to be raised to 0.75 or possibly 1.0. So if Bank of Japan determines to raise it by half a percentage point, which is about 100% raise, I think that's going to have a significant effect upon global financial market. But I believe that this time, I think Bank of Japan will raise about 0.25, 25 basis point. And in that case, I think the significance of, the movements of end-carry trade is not going to be very significant, especially for Korean markets. So everything comes down to how high the Bank of Japan will raise December 18th.
So we'll look into the amount of how much it would decide to hike or down. Now, staying on the investor behavior ahead of the FOMC, both Wall Street and Korean equity markets showed mixed movements and cautious sentiment. Professor Lee, what is the core uncertainty weighing on investors right now?
It's quite interesting what has happened for this time around. Wall Street and a lot of investors in Korea predicted that there's going to be a rate cut for the Federal Reserve. So this is not a surprising news. So everyone predicted that this was going to happen. But what's really interesting is the statement by the Fed and also the press briefing by Chairman Powell about what has happened with the rate cut this time around. As you know, the FOMC typically meets around 8 times a year, and you have bunch of voters and governors and board members who vote on these things in terms of whether or not to increase or decrease or make the rate remain at the level. Now, what happened here is that 3 people actually dissented with this decision. What that means is that 3 people disagree with the decision to lower the interest rate for the Federal Reserve Bank within the FOMC, largest rate since 2019. So what that means is that, as the press briefing from Chairman Powell suggested, which he said that everyone here agrees that there's some elevated level of risk for inflation. At the same time, the job market here in the United States is quite weak. But the weight of which how we're going to tackle that issue is the biggest risk, and also what the investors are seeing, where you're seeing that the investors do not know what will happen with the Federal Reserve Bank. And the idea here is that as we go into 2026, the rate is going to be actually lowered, or maybe it's going to remain strong given there's going to be increasing pressure and disagreement within the FOMC. And just to put another note here, which is that the Fed chair is going to be replaced by next year. So as soon as the next month, where you're going to see that Trump ally may be appointed for that role as well. So there's going to also be another source of uncertainty there as well.
Right. So with all of these uncertainties leading to cautiousness and also rising bond yields and renewed won volatility, Professor Shin, how are these shifts actually affecting domestic borrowing conditions, especially for rate-sensitive industries?
Well, I think from last September, Korean the bond rate has been rising pretty significantly, and at the moment, 10-year, the government bond is about 3%, and it is expected to rise. The reason for the bond rate rise is there's a little possibility, at least in the short run, the Bank of Korea will lower the rate. It has become very clear that Bank of Korea has changed its stance of keep lowering the rate to keep steady for the time being. So there has been little hope or possibility of lowering rate, and that is one of the reasons that the bond rate has been rising. Another reason is that the government has to issue a tremendous amount of bond issue down the road, 2026 and 2027, judging from the characteristic of the current government. So government has to sell huge amount of government bonds, and that necessarily lower the price, which means that rate will go up. So I think the bond rate will go up significantly, at least I think 50 basis point next 6 months. And if the bond rate goes up, the market rate has been tied to the bond rate, so it has to go up necessarily. So I'm expecting that year 2026 we'll be expecting at least a 50 basis point rise in the market rate. So it's going to be very difficult to raise funds, and it's going to be very costly to borrow from financial institutions.
And that's really where the real world impact starts to show. So when we look into the details a little bit, we're seeing a recovery in the semiconductors and export-driven sectors. Professor Lee, do you think the strength seen in that sector is broad-based enough to lift the overall economy?
Well, I think it still remains to be seen the overall impact of the increase in export and how it's going to increase the GDP for South Korea. So if you look at the GDP formula, it includes the consumption, investment, government expenditure, added with the export minus import. So what we're seeing is the some increase in exports, so which will naturally have increase in GDP. However, what's happening with the Korean economy is that there is a rise in the government expenditure component as well. At the same time, there's a lot of issuing of the consumption coupons for consumption at the same time. And so you're going to see that the macro potential in the South Korean economy will be volatile. And also there are some volatility within the won-dollar exchange rate, which will have also impact on the export revenues. And so it remains to be seen, especially in the macro side, how that will affect the GDP moving forward. Obviously, the current minister has predicted that it might be a 1.8% growth moving forward, but the OECD figure this month actually is quite more conservative. So we have to see what will be the case for the Korean economy moving forward, especially within the export-driven sectors.
So we'll really have to keep close tabs on that front. Now, on the other side, private consumption and household sentiment remain weak. Professor Shin, how serious is this disconnect between external gains and internal stagnation?
Well, for the year 2024, last year, export has contributed to Korean growth in terms of percentage point, 1.8 percentage point, which is huge. But we have to remember that in Korean kind of economic structure, when we make exports, we have to import a lot of raw materials and parts from outside. So net effect of trade on economic growth is very little. I'm expecting that year 2025 is going to be about 0.5%. And another 0.4% from domestic demand. So even if we perform pretty well in export, especially in semiconductors, net effect in economic growth contribution is very little. So for Korean economy to grow substantially, we have to rely upon domestic demand, mainly consumption. In 2002, about 23 years ago, domestic consumption contributed 5 percentage points, but last year it's one half percentage point. So I think it's going to be a critical question and critical task for Korean government to raise or to boost Korean consumption. And I don't know how to boost the consumption. The current government has been giving a lot of stipends and money to the people. But the effect has to be seen, how really that has contributed to Korean economic growth. But for sure that, it's very difficult for Korean economy to make 1.8 percentage point next year, 2026. I think it's going to be very difficult. I want you to remind that last year at this time, every major forecast institutions expected that a growth rate for Korean economy 2025 is over 2.0%. Now it's a little less than 1 point. So I think 1.8 percentage forecast for next year. I think it is too optimistic.
Then, Professor Shin, speaking of the growth forecast of the nation, we're seeing a divide between the OECD. It downgraded Korea, while the ADB actually raised its projection. Which view actually do you think reflects?
You have to remember, OECD lowered from 2.2 to 2.1%. they call it downgrade, and ADB raised, but it raised from 1.6% to 1.7%. So actually, they were closing together, So in that sense, it's not very strange. I think, but still, a 1.8% forecast for 2026. I think it's very difficult to achieve, understanding global economic situation and the Korean a very slowdown in domestic consumption.
So, yeah, so we'll really have to see. The gap, though, is definitely narrowing.
Yeah, right.
Now, let's speak beyond the numbers then. Labor market duality, aging demographics, and housing imbalances still is a big problem that remains unresolved. Professor Lee, how urgent do you think are structural reforms if Korea wants to avoid stagnation?
Yeah, so obviously the structural reform is required in order for us to look at the new economy moving forward. You talk about the age of AI and new technologies, so there's going to be some shift in the labor market. So it's no longer based on a lot of manufacturing that which Korea is used to, but now we're moving toward more of a computerization, a lot of automation, which means that the service sector will be more stronger. But with the issue with the stagnation here is that you mentioned some of the issues, and mainly it's about the housing imbalance in Korea, and obviously the housing prices in Seoul is going up, where others are not going up as fast, and so that puts an increased pressure on prices. What that means is that young people cannot start families or switch jobs or take on different things, even though the headline GDP is doing well. So what that means is that the foundation for the current economy is not doing so well, although the numbers may speak differently. And so that really is what I think what we're discussing here, and also alluded by Professor Shin about some of the discrepancies in some of the projections. For example, OECD this month has predicted that one of the takeaways from the Korean economy is the largest government deficit budget, as well as the coupon issuing with the consumption things. And in the long run, we need to look into you mentioned some of the structural transformation, how the policy for the government, especially debt to GDP ratio, will manage moving forward, given the volatility in the global bond market, where now that's having a direct impact for the government bonds, which is related to issuing debt. And so everything is all tied together, and I think it's a great opportunity for us to look at moving forward next year, how the policy direction will be formulated.
Right, definitely. So we are at the end of 2025, nearing opening with the 2026. So with this, Professor Shin, given the shifting global policies and Korea's own vulnerabilities, what do you think is the single most important macro lever Seoul should focus at this time around?
Yeah, we've been talking about structural adjustment for more than 2 decades, and it's very difficult to come by. And for me, I think one of the most important driver of Korean economy is business. Okay, so the government has to invite many business-friendly policies. So I think government has to try to encourage, business spirit on the part of businessmen. That I think is most important. And as far as I'm concerned, most businessmen that I have met, they are pretty, negative about, current government, in the sense that government is not respecting the contribution of business sector. They don't respect, the job creating power of businesses. So before we're talking about the structural adjustment, I think we have to boost the business spirit on the part of businessmen and corporations. That I think is the most important thing. And in order to do that, I think government has to focus upon deregulation and emancipation of so many regulations in business world. I think that is most important thing for the current government, has to boost up Korean economy, economic growth, and economic productivity.
Right, so a little push to support the business sector would be helpful leading up to the next year. Thank you so much for your insights, Professor Shin.
Thank you.
And of course, Professor Lee, we really appreciate it.
Thank you so much.
And that'll be all from us on Within the Frame tonight. Be sure to tune in again next time as we continue to explore the stories that matter. Until then, stay informed and engaged.